I tell clients, if you buy a 20-year term policy for $1 million on an 18-year-old, it's $20 to $25 a month. And I'm not talking about the cheapest. I'm talking about one with a carrier you would be proud to convert to their permanent policy.
Yes.
Okay.
Convertible term.
You got to set, but term with a company that has conversion options that you'd be worthy of having.
Yes.
Right?
Yes.
And so I sell more life insurance to parents for 18-year-old graduating seniors as a setting the table for their future insurability and the protection of their families. And I convince parents to commit to doing that for their kids. And why $1 million? Well, you can sell $1 million to an 18-year-old no matter what the wealth of the family is.
And they can afford it.
They can afford it, but the insurance companies aren't going to balk. You try to go more than $1 million unless they're a special wealthy family, insurance companies aren't going to sell you more than $1 million on an 18-year-old. Otherwise, I would tell you to buy all you can at $25 a million.
Yep.
And if you want to have a great career selling life insurance, start selling all your parents for their seniors.
Yeah.
20 and 30-year term life insurance is a tee-up for their future.
Talk to me about why life insurance unlocks options and potentially makes someone's situation better. Like I would imagine if someone had permanent life insurance in their 50s and 60s, it gives you, from a planning standpoint, more options than if they didn't.
Well, so I bought a policy when I was 28 where the payment was bigger than my house payment.
Wow.
And I wasn't sure I could do it. And of course, today, my dividend, I have participating whole life. My dividend, a guaranteed increase in cash value, are 3.5, 4 times my annual premium. Now, I wished I would have bought a variable life policy, to be honest with you, because I wish I could stuff. I wish I had a higher MEC limit.
You have a first world problem of not being able to put as much money
I'm
as
limited
you want.
on how much I can put in because even if I put a PUA rider where I stuffed money in on the front end, you don't fund those for 2 or 3 years. You can't fund the PUA rider anymore. So I'm constrained on how much I can put in, but I would never think about not making the payment because I want to grow that cash value. It's growing at a clip of about 6% with dividends and the dividend on the dividend, the guarantee increase in cash value. Net of all expenses, net of all fees, it's like one of the best fixed allocation investments I have. It's a buffer asset. So if I have to pull money out of something that would be like, I've got a great investment in my after-tax portfolio and I don't want to sell it. And maybe I don't want to touch my Roth IRA, but anything else I touch would be somewhat taxable, long-term or ordinary income tax. I can go in there and take my basis from the policy for a month or two until something else pops up or make a little more income. I turn around and pay it back with just the interest associated with the number of days it was loaned as a buffer asset. No tax at all. Very cheap cost of capital, liquidation, and availability. And so I use it as a buffer, not just for retirement, but, I did when I was on the farm and money got a little tight one time. I needed a new lawnmower that would mow 8 acres a week. And this lawnmower wasn't the lawnmower you think about in the city. And this is 72-inch front mount diesel hydrostat. That is an expensive lawnmower. I borrowed the money out of my life insurance policy because the only other place I get money at the time was my 401k as a loan or a distribution prematurely out of my IRA. And so I wasn't going to do that. And so I took a loan out of the policy and bought that lawnmower for my family, and we paid that money back. But it creates capital where you can be your own bank. I believe in many, not all, the infinite banking concepts. If I found investment property, again, be careful here, but if I wanted to throw some money in on an investment, I could double down and create an investment property income and use that distribution of that income on an investment property to pay my loan back. Again, I'm not advocating these are all appropriate for everybody, but the fact is I have the option. I have the flexibility. Building flexibility into retirement, building flexibility into capital is the most powerful thing we can do. And the unfortunate thing is that a lot of advisors perceive it when you buy and lock down money in an income annuity, you've limited your flexibility. No. Because you so constrain the allocation for the distribution guarantees that you're getting, you freed the maximum amount of dollars with no risk. And so, by the way, do the math on mine. If I put $500,000 in, I'm getting $82,000 a year. Am I getting 4% back? Am I getting 8% back? It's a high distribution rate. that I'm getting back. So forget the 4% rule, forget the 3% rule. I can say that because I locked in guarantees.